Kính chào quý vị khán giả. Hello Viet TV Canada. Welcome to the Wealth Expert Show, the show where we teach you how to make the best use of your money to reach your goals in the most efficient way possible. Consider me your financial GPS. I'm your host and wealth advisor, Mitchell Huang. Last week, we discussed the qualities you should look for in an investment advisor. This week, we discuss factors you should consider when buying a home. Buying a home can be a daunting task. It's hard to know whether you're ready to buy a home. The shift from renting or living at home to owning your first property can be intimidating. We will discuss a few issues you should look into, such as your credit score, getting a mortgage pre-approval, the down payment, and the value of a good realtor. Generally, one of the first things people think about when buying a home is the mortgage. When it comes to the mortgage, the very first thing you need to do before looking for a home is getting a pre-approval from the bank. A pre-approval is a written agreement with the bank that they will lend you a certain predetermined maximum mortgage amount at a guaranteed interest rate. This rate is locked in for the next 90 days. This doesn't mean that you have to take this rate or stay with this bank. However, it means that worst come to worst, that this bank will guarantee you that amount at that rate. So if you find a better rate elsewhere, feel free to finalize your mortgage there. The pre-approval's main purpose is to let you know what value of a home you can buy. This allows you to budget the purchase of your home. So if you are pre-approved for a $400,000 mortgage and you want to purchase a $500,000 home, you will need to have a $100,000 down payment. A good rule of thumb is to take your combined gross income and multiply that by 4.5. So if you are making a combined income of $80,000, which is approximately $40,000 each person or each spouse, then the maximum amount of mortgage you can qualify for is approximately $360,000. Things you should consider when it comes to your mortgage are obviously the rate, and secondly, the repayment options. All banks have relatively the same rates when it comes to mortgages, as all the banks are offered the same borrowing rates from the Bank of Canada. Whether you get 2.59 or 2.69 for a 5-year fix is almost negligible. You are looking at a difference of approximately $20 each year. What is more important is the fine print, the penalty when breaking the mortgage, and the repayment terms. The more flexible your mortgage, the better. Having the option to double up the payments whenever you want, or putting down a lump sum of 10 to 15% of the original amount, or increasing the regular payments by 20% will have a large effect on the amount of interest cost. This is because of the extra payments you make on top of the regular monthly or bi-weekly payments go directly towards repaying the principal amount rather than the interest. A lot of people are debating between getting a fixed mortgage, which is one in which the rate is fixed for a set number of years, or a variable rate mortgage, one in which the rate paid is based on the prime rate less a discount. Normally, you will see variable rates as prime minus a number. For example, prime minus 0.7. That means if the prime rate is 2.85, your mortgage rate will be 2.85 minus 0.7, making your current mortgage rate 2.15%, which is significantly lower than the fixed rate. The one drawback to this type of mortgage is that the prime rate increases or decreases. Your mortgage rate also fluctuates accordingly. However, the prime rate is not adjusted often, and when the prime rate is increased, it is a minimal increase. Therefore, in this low interest environment, a variable rate mortgage will work towards your benefit. The second thing you should consider when applying for a mortgage is your credit score, also known as your Beacon score. Your credit score will dictate whether you will qualify for a mortgage from an A lender. An A lender is one of the big banks. A lenders generally have better rates and better repayment options than B lenders. B lenders are smaller financial institutions which charge a higher interest rate and also have a higher mortgage break penalty as they lend to higher risk individuals. So how can you raise your credit score and become a low-risk borrower? Quite simply, always repay any debts you have on time, whether it is a Visa card, a line of credit, or a phone bill. By ensuring you at least make the minimum payments, your credit score will not be affected. By continuing to pay the full balance owing and never maxing out your credit cards or lines of credit, you can raise your credit score. If your credit limit is $10,000, never borrow more than $7,500. If you max out your credit card or line of credit, the system sees this as poor cash flow management, which makes you a higher risk borrower, which then lowers your credit score. A lenders cannot approve you for a mortgage if your credit score is below 650. So if you are planning on purchasing a home in a year, make sure your credit score is strong. The third thing you should consider is your down payment. As home values keep appreciating, it is often hard to keep up your savings. Having a sizable down payment requires planning ahead. Best case scenario for a down payment is 20% of the purchase price. That means if you are purchasing a home for $500,000, you will need a down payment of $100,000. Having 20% down allows you to avoid the high ratio mortgage insurance from CMHC, which is the Canada Mortgage and Housing Corporation. A high ratio mortgage is any mortgage with less than 20% down payment. This insurance amount is added onto your mortgage amount. It is generally several percentage points on the purchase price of the home. 20% is sometimes hard to accumulate for a down payment. The good news is, for first-time home buyers, the government allows you to beef up your down payment by drawing on your RRSPs. This is one of the few exceptions to drawing on your RRSPs tax-free. The only limits are you can only withdraw up to $25,000 for each homeowner, and you have to repay 1/15 of the amount to your RRSP account every year, or you'll be taxed on the outstanding amount as income. For example, if you withdrew the full $25,000, then every year for the next 15 years, you will have to repay $1,667 to your RRSPs. This is generally good practice to speak to a financial planner who can educate you on the amounts you will need to put aside every month to reach your down payment goals, according to your timeline and how your cash flow will change once you are a homeowner. Remember, you can't enjoy life or work towards other goals if every cent you make is going towards paying your home. Other factors you should consider are finding a realtor. Look in the phone book, online, or ask friends. Ask the realtor for references, experience, and success rates, and make sure you feel comfortable with the agent. Your realtor should be well informed about every aspect of where you are looking for a home, such as the attributes of the neighborhoods, schools, and community groups, and have experience negotiating deals in your price range. Budget for extra expenses, such as moving, new appliances, and utility hookups. Moving costs vary, but the average is about $500. Utility service charges for electricity and phone will total to about $150 to $250. Add appraisal fees, title insurance, and survey costs to your budget as well. Prepare for closing fees. Generally, I recommend setting 3.5% of the price of the house aside for closing costs, such as land transfer taxes. So if you are buying a $500,000 home, you should be setting aside an extra $17,500, which is 3.5% of the purchase price. Something to note, if you are a first-time home buyer, you may be eligible for a land transfer tax rebate. Avoid hidden costs and headaches with a home inspection. It is worth the approximately $350 to get that home checked out before you make the commitment. Your real estate agent will advise you on how to make your offer conditional on the inspection. When viewing the home with your real estate agent, ask as many questions as possible. The selling agent is not legally required to tell you everything that is wrong with the home. They only have to disclose the information if you ask them. So make sure you ask if anything seems out of place. I heard a story of a couple who purchased the home in which one wall of a room was newly painted. Unfortunately for them, they didn't ask why. When it rained a few months later, the couple discovered that that wall had a leak and the paint was to cover it up. They ended up having to spend an extra $20,000 to fix it. So always ask, ask, ask. By asking questions, you not only protect yourself as a buyer, you may also lower the asking price, since you have exposed areas in which you will need to spend money to fix up the home. That amount can be deducted from the purchase price if your realtor negotiates those terms for you. And lastly, keep your emotions in check when negotiating, because they can lead to an impulsive buy. Be prepared to walk away if a bidding war drives up the price of your home. Tune in next week as we discuss home buying tips and selling tips and tricks with the renowned real estate agent and brokerage owner, Sam McDaddy. I look forward to all your email questions. Have a topic you would like me to discuss on the show? Need a financial plan done for you and your family? Or want some investment advice? Contact me anytime at mitch@wealthexpert.ca. Thank you to all of our viewers and see you next time on Viet TV Canada's Wealth Expert Show. This is Mitchell Huang, your wealth expert, signing off until next time. See you then. Bye for now.